All right, this is being recorded, and at the beginning of every single webinar I say watch it again. Why? Because it will help you remember this strategy and all my rules longer. If you wait a month, you are going to be learning this all over again. Yes, you can go online and figure out how to do an iron condor, but they aren't going to have the specific rules I have in order to set this strategy up. You know, we could do this in any environment around just about any underlying, but I will show you why you should not fall into those pitfalls, because you will probably end up losing money. But set it up the way I do. We're increasing our probabilities of success, and I'll show you why that all comes to fruition as we build these strategies out. You know, that I feel like that's the way people are going to learn, is to go through it and actually go through the steps once we learn all of those. So let me get a couple of things out of the way real quick, though. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Been trading my own money since college. Started out with a psychology degree, and when I started trading, I realized this is what I really want to do, and switched it over to finance. After graduating, moved straight to Chicago, packed all my bags up, moved straight to Chicago, and walked onto the floor. Never even made a resume or anything else out. I just walked on the floor and started telling people I just graduated and wanted a job. Started out working in the 10-year options, and then moved around 30-day Fed funds. I was bean options, corn futures, and traded in the Dow pit. I didn't really do any brokerage over there. So in that time, I've traded everything, like I've already mentioned, pretty much stocks, financial futures, commodities, and options on all those products in just about all market conditions. But let's go over this disclaimer really quick. Please read over it. It says any opinions, news, research, and analysis or other information contained here or provided by Pro Trader Strategies, associated companies, or employees is for general commentary. It's because I don't know what's in your portfolios, you guys. There's no way I can say you need to go out there and buy a tech stock or put tech in your portfolio if you're already overweighted tech. Okay, so we need to take what I'm teaching you in these videos and implement it into your portfolio in your own way. And please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right. You can also follow me on Twitter at Wolfman's Blog. That's the top one, or our parent company at Pro Trader Strat for all kinds of daily market wisdom and or snark from me. I also tweet out all the trades I do in the afternoon. I try and get a lot of my trades in the morning and then talk about them in the daily market commentaries. But there are things that I put on in the afternoon, and if that does happen, I'll tweet that out to you and let you guys know so you guys can play along. All right. Mentioned this is on the short iron condor, and we need to have a market assumption where we believe this underlying is going to be range bound. You know, we've seen a lot of them recently get into a range bound, especially like the bank stocks right now. They don't have the implied volatility we need necessarily for this iron condor, but we do need to have the assumption where we believe that there is going to be some type of force that's going to keep this within a certain range bound area, or we're just market neutral in general with our market assumption. We think, well, it may go up and down, but at the end of the day, it's going to pretty much stay within a few ticks of where we are right now, and therefore I'm going to go with this strategy. All right. One of the things besides range bound we need to have in order to be successful is really have volatility collapsing, or what we used to call on the floor volatility crush. And that's really when we see volatility come out really quickly. And that is a product of volatility. We see volatility come into the markets, but usually the volatility comes out much quicker because that buildup of anticipation before that event usually being overstated. Volatility is generally overstated, just like fear of heights or fear of spiders and things of that nature. People may be afraid of heights and are afraid to go on a chairlift, say on a ski lift. Well, that to me seems a little bit overstated, because you aren't sitting at your office and just falling out of your chair all the time. What's the difference if you're 50 feet in the air? You're not just going to fall out of your chair, right? So it's overstated when you're fearful of those heights in a situation that really doesn't make sense. But once you get off of it, you're all of a sudden relieved, and that volatility, you realize, oh my gosh, that was just crazy for me to be so scared. And that volatility crush comes out. Okay, so that's kind of the idea. Same thing with markets. When we are fearful about something going on in and around, say, Boeing, where we've seen some lot of news around Boeing lately, volatility has spiked for no other reason other than the fear. Well, I'd say that fear is a little bit overstated at this point. They know what the problem is. They've grounded all these airplanes. Those planes that are already purchased are already accounted for with Boeing. It hasn't affected any of their future sales because it's a basic software glitch. All right, so that can easily be fixed. So in a sense, it might be a good time to do something in and around Boeing, right? Just as a quick example. But we want that volatility to really come out. And the way we build this thing out is we start out kind of like a strangle. We've learned the strangle already where you're selling a call and a put. But what we're doing is we're defining that risk with this by going out and defining that risk by buying a call and a put to define that risk. And another way we can look at it is we are selling a call spread and adding that to a put spread, okay? And when it really kind of breaks down, we can easily look at something like this. This is what a short put spread would look like on the Analyze tab. Now, I did this by hand, on Microsoft Paint or something. So it may not be perfect, but you get the idea. You have your defined risk on the short call spread. You lose money if the market goes up. You make money if the market goes down. And with the short put spread, if the market goes down, you lose money. And if the market goes up, you make money. Well, when you jam those two together, you get what the iron condor looks like. But the key here is in low implied volatility, a low implied volatility percent for that underlying, you're going to have the two short wings very close to where the underlying is currently trading. But when you get volatility, it allows you to get further away from where the underlying is trading. So if it's Andrew's like, good diagram. I don't know if that's facetious or not. But at the end of the day, if these were XYZ and this was a really low implied volatility for XYZ, you can see that it's very narrow. What we would want to happen is do it in high implied volatility. When that volatility comes out, you can see it would narrow up. That would be good for us because that would all of a sudden our premiums would start deflating. And that's really what we're looking for in this strategy. And some time in there. The time is going to help us, but that volatility coming out quickly will be a factor that affects our premiums much quicker than the theta decay, okay? So we would like to be able to have our short strikes much further away from where the underlying is trading, and that's what we're ultimately going to try to do here with high implied volatility. So our essentials to success. Now, this is the steps that we go through when we're determining whether or not the short iron condor is appropriate for the underlying we're looking for. All right. You could look at the underlying first to see if it's appropriate also. You don't have to go through these steps necessarily in exact order as long as you check them off and they're all green lights. And if you have one or two yellow lights, then I would say you're still okay to go through with this. If you have all yellow lights, then I would say move on to another strategy. And if you have a red light in there, I'd skip it altogether. But picking the right environment. I've mentioned this before. We need high implied volatility percent. And the way to find implied volatility percent is to pull up a platform. Let me get this. I'm slumming over here with just two screens. Usually I have several screens and it makes it a little bit easier. So let me just blow this up here. So ADP isn't necessarily one that I'm looking for this particular underlying, but what we need to do is find out where its implied volatility is for itself. And what we do is I have this on a chart, and you can see already it is really low. It is not in the upper half of volatility where this underlying has been trading, right? It's really low. As a matter of fact, we could say it's probably very close to zero. We want something that comes out and it's above the midline here, above an IV percent of 50. And I can find a better example. Let's just go with something like IBM, because it's going to give us a better reading in a sense. And this is an IV percent of 50. We can see that already over there. But what you do is in the numerator, in the denominator, we have two sums that we need to divide by each other. In the numerator, which is on top of the fraction, we take 25, the current IV minus the low IV, take that sum and divide it by the high minus the low, okay? So currently we have 25 minus the low in the numerator, which is 15, right? So 25 minus 10 is 15 in the numerator. And we divide 15 by the sum of the high, which is 40, minus the low, which is 10. So 40 minus 10 in the denominator is 30. So our total is 15 divided by 30 gives us 50, right? So we have an IV percent of 50. That would, because it's just slightly below, I'd say, that's probably a yellow light for this particular underlying, as long as you would be expecting volatility to be coming out of this underlying. We don't want to do this trade well in advance of earnings. You can do this trade for earnings, but I have specific rules for that. So please follow those in the earnings videos for the webinars for trading strategies around earnings. All right, I have different rules for that. Make sure you follow those for that specific instance. But 5-6 days ahead of time, I don't want to do that. I would want this one to kind of get stuck in trading in this range. I'm assuming there's no earnings in IBM right now. But let's say it's got the IV percent of above 50. That would make that work out for us, okay? So very close to an IV percent of 50. That's what we're looking for. The reason why it makes those wings get further out, where we're shorting the parts of the call and the put, we'll be able to get a lot further away on this particular underlying. So let's take a look at it real quick on the rest of our rules. So we've got that, right? We've got it, the right environment, which is an implied volatility percent of 50. With ETFs, good question. ETFs above 30. The reason why, it's a basket of goods. There's a lot of different underlyings in there that have different volatility coefficients, and they have a tendency to meld each other out. So with an ETF above 30 is good for premium selling strategies, and the short iron Condor being a premium selling strategy, it is good for that as well. All right, so picking the right environment, we want for a particular underlying, a stock above 50. For an ETF, which is a basket of goods, we will do that one above 30, all right? Now, picking the right underlying. This, we need to make sure that we have good markets. And those good markets are reflective of tight bid asks in the option montage. So when you go over here to the trade window and you see all these options in here, this is the option montage. That's what we're looking for. And for this particular rule, picking the right underlying, we need to go to the one that has close to about 35 days to expiration. This is the spot month. Not very many people are going to be trading one day to go, but most people are going to be trading around that 35 days to expiration. That's considered the spot month, or the one we're going to be looking at for this particular rule. And any stock over $100, what I want you to do is just move this decimal place 3 ticks to the left, and we come up with, let's say, 14 cents. We're rounding it up. So down here, we look at the option montage, and we should see that all of this pricing in the spot month is inside of 14 cents from the bid to the offer. And you can see this one fits that rule pretty good. It's after the market's closed, so make sure when you're checking this rule, it is during open market operations. There will be much better bid offer or tighter markets in here. Once the market's closed, a lot of people cancel their orders, so they're not reflective here. So 3 ticks to the left on a stock over $100, that's how wide it should be. If it's $1,000 stock, then it would be $1 wide down here, all right? And any stock under $100, what we want to do is make sure that, let me just find one. My screen is really far away to look at. So a stock under $100, basically what we want to look at is make sure that from the bid to the offer in the spot month, it is 10 cents or tighter, meaning, less than 10 cents. 10 cents or tighter than from the bid to the offer, okay? During open market operations. That would make it an appropriate underlying to trade options. And remember, with this strategy, we are having a short call spread, which is 2 legs, and a short put spread, which is 2 legs. So we have a total of 4 legs to this strategy. Now think about it. If we were dealing with an underlying that was under $100 and the bid to offer was 25 cents wide in that option montage, all of those different legs are going to have to give up edge in order to get filled. And the more edge we have to give up, we have to make up for that in theta decay or in volatility collapse before we get, back to a point where we can be profitable. So we need to make sure that we don't give up a lot of edge in this strategy, because it's very easy to do if there's not a lot of eyeballs in the underlying you're trading. So make sure it has tight bid ask. And the right duration, I mentioned this. We want to go with the spot month for this strategy because it has the most theta decay. This is where we're seeing this volatility come out the most, is inside of 35 days. I usually like to try and set it up just outside of there. We're right there. I'm fine with it. But I like to even set it up just slightly outside of here if I can, because you get that theta decay. 50% drop in your premiums over these next 21 day or 20 some odd days. Okay. So if, we're looking for our profit target of 50% of that max profit, we could easily say that we're going to probably achieve that within 28 days. If volatility didn't change and the underlying didn't move, we should be able to get out before this big theta decay area. But there's a lot of things that go on in here, and I talk about it with the gamma trades and stuff like that. I like to stay out of here because this is where big money starts to push stocks around to get their settlement, and they've got a little bit more buying strength than you guys do, so they are going to be able to push it where they want, despite the fact where you want it. So get out early before all those games start getting played and make your money and walk away. All right, so 35 days to expiration, because we want this theta decay. And this is representative of at the money. Your theta decay diagram or theta decay slopes will be a slightly different for the ones that we're dealing with, but it gives you a good idea as to the closer you get to expiration, theta starts really picking up. Way out here on the timeline, there is very little theta decay. We don't want to get out there. We want to see our premiums come out quickly. So why not get at the steepest part, or the most well, it's got the best bang for your buck. Down here it gets a little wanky. So stay inside of this area. Somewhere closest to 35 days to expiration is what we're looking for. And then picking the right strikes. Now with this one, we're going to try and do it where we're looking at being around 1 standard deviation away. Now I've showed this bell curve many times when we're talking about options. If we think this is the call side because it's positive, this side's the negative side because it's puts. Negative markets, positive markets. We're going to try and start shorting our call spread and put spread at about a 1 standard deviation move away. The higher the volatility is, the more achievable this becomes. Okay, so what we do is we're going to start out around that 16 delta, which is about that 1 standard deviation move. I will tell you, a lot of times you have to move slightly into around the 20 delta in order to get this strategy filled, okay? I'll talk about different ways that we can make this a little bit wider even, like we used to do on the floor. It increases your risks a little bit, but it also increases your probability of success, all right? But you can only really get the big boys with the big stocks, being like, the over $100 stocks, and probably even over $200, $300 stocks. because then you can get further away, you get a nice collection. You are increasing your risk, but you did increase your probabilities of success. This strategy does not work out very well with stocks under $100, okay? Because your width of your strikes are going to be like 50 cents wide. You're only going to be able to collect about maybe 20 cents for it. And after all the commissions on this strategy, it doesn't make it worth it. So you're going to need to stay away from those really low priced underlyings, okay? Probably want to be above 50, and it really starts giving you a nice premium above those $100 stocks. But we're going to try and set this up looking at about the 16 delta call input for our short call input, and then we'll probably have to move it a little bit, actually move it in slightly. I said out, move it in slightly closer to the 20 delta, which will be probably right around in here, okay? And knowing our exit strategy, this is the ultimate thing we need to do, right? Plan your trade and trade your plan. That's the way we have to do this. Plan your trade means going through these essentials to success, but also writing that down on like a spiral notebook or something where you can write down all of your trades so that you have the data to go back and look at to see if you're doing everything right. And to see if it's working out appropriately. You'll be able to figure out over time your probabilities of success. Are they matching up? What am I doing that maybe Wolfman wasn't saying, or Wolfman told me I needed to do this, but I thought I could do it my way. Is it working out the same? And you can compare and contrast with me. I would believe that I've already done that for you, so might as well go with my rules. But knowing the exit strategy, we're looking at about 50% of max profit. Now, if we start getting into that really close to expiration, remember I talked about that, where we don't want to be messing around in there where those big guys are starting to push it away. Let me try and find that theta inside of here. If I start getting inside of like 15 days to expiration, I'm going to be willing to take a little bit less of a max profit. I'm probably going to be looking at about 25% of my max profit at that point, right? So if I collected $2, I'm going to be looking to just get out at like 50 cents or something, because I don't want to deal with what goes on in here. The gamma will start affecting your premiums. A small move either direction can really start making bigger fluctuations in your profitability on this strategy, especially if one of those is getting close to being tested, where the market has moved maybe close to your short calls or something. I'd be willing to take about 25% of my max profit if I had to go inside of these, last 14 and especially 7 days, okay? But outside of that, if I can get 50% of my max profit at any time, I'm going to be taking it off, right? But if I can't get to 50% of my max profit and I'm looking at like 25% of max profit and I'm right in here, I'm probably going to take it off, because I don't want to play these reindeer games. Santa Claus doesn't come to my house on those days. He might come to yours, but not mine. So we're looking at 50% of max profit for our exit strategy, and 25% if it's really inside of that last 15 days. Just look to get out of it. All right, our max profit is the premium received minus your commission. So anytime we're doing a premium selling strategy or collecting premium, that is our max profit, is that premium we collected. And then our max loss is limited because it is the width of the spreads. It doesn't matter which one it is, right? Because we can only have one get tested. We can only be wrong on one side of this. Market can't go both ways at the same time. So our max loss is limited to the width of our call spread or our put spread minus that premium. So if I'm looking to collect a third the width of the spread, right? I have a $1 wide spread and I collected 33 cents. My loss is that 67 cents, right? $5 wide, I'm going to be looking to collect about $1.65 on a $5 wide. So my loss would be the remaining $3.45. Okay. So pretty easy to figure out because it's defined risk. And then our break even is going to be either our short call a short call strike plus that premium, because remember the short call, we collected a premium. Our risk is that short call, right? But we collected a premium, so above that is where our break even. And then vice versa, if the market's going down, we start losing money when it starts going below that short call, or that short put, I mean, and then buy the premium. So if we collect a premium, it gives us wiggle room to the downside, right? That makes sense to everybody so far, right? For the break even. And then we're getting out at 50% of max profit. So this is where I throw it out to you guys. We're going back and forth. If you haven't realized, people are asking questions in the questions box. That's how we're going to communicate. So please throw out stocks in there. We will go through the option montage and all of these steps to see if it's appropriate for this strategy. Okay. Somebody threw out, what was it? Walmart. So let's check out Walmart. So Walmart, we already kind of took a look at it, and I think Walmart has pretty low, I don't want product depth, I want option statistics. So current IV percentile is at 5%. We want something that's up here above 50. Somebody else threw out, so that one's going to pass. It probably would go through, and that's a red light, you guys. Like, when I was talking about green lights and yellow lights, if it was an IV percent of, 47, 45 or something like that, and I expect volatility to come out, I'd say that's a yellow light for this strategy. But being this low, I would just stay away from it. The reason why is here. We can look at a really quick example. I think I had of, what is this? Lulu. So let's take a look at Lulu. It has high implied volatility. Now, if we were going to look at this strategy for it, I know it has earnings coming up, but let's just look at Lulu. We've got $140, $45 stock, so 15 cents wide. Look at the bid offer, make sure they're 15 cents wide. This one is so far away from it, it's not even funny, but during open market operations, it works out. So what I was saying is we're going to go out to around that 16 delta, look for it to see if it's appropriate, right? So this is about as close as we're going to get to it. Like I said, you're going to look at the 16 and have to come in a little bit tighter. So if this one was the one we're going to kind of look at, so let me try and set this up. So we're going to hit the control on that one and then buy that one. So that's our short put spread. And then we're going to go up to the call spread and look for those same ones. And it's probably, I'm going to not have that 16 delta. It's going to be the 15. I don't think it's going to work with the 15. Let's just take a look. Sell that one, buy that one, $1.39. So that's not the premium we're going to be able to do. So I'm going to get rid of that one. So let's try we got to go a little bit closer and do that. So it's about $1.58. It was trading a little bit higher. We wanted it up into $1.60. So that's probably where I'd put this strategy in. Now let's take a look at it. It's trading 144 last, 145. So this is the closest to the at the money. If you can see, from 145 to 165 is our short calls. That's 20 to the upside, and we were 20 to the downside is 20 to the downside, from 145 to 125, 20 to the downside. So we are 20 ticks away in either direction, right? So we go over to the charts. 20 ticks up puts us at a new high, and 20 ticks down puts us, below the value area low here a little bit, or very close to it. So that's a pretty wide swath, or whatever you say. I don't know if I'm saying that right. So let's go down and try and find a stock that's about $140. Let me shrink this just a little bit to see if we can see all of my stocks over here on the side a little bit easier. So we're going to look at, I'm looking for a stock that is going to be very close to that 145, just to give us an idea of something that's really low implied volatility. And 145, let's see, is there anything down here? 145, I thought I saw something earlier. Let's just go with the what is that, ADP? Let's go with ADP. It's a little bit higher, but we can even take a look at Caterpillar. It's $10 lower than this other one too. But this has really low implied volatility, right? So, but about the same. I mean, it's $10 difference, but let's just take a look at the same idea as to going out to that 16 delta, start out there. You can already see right now we are not getting any, we are not getting anywhere close to where we need to be in collecting a premium, right? We're already not going to be able to get to $1.60 there. So let's try that one, 85 cents. So we got to go a little bit closer on this one as well. So sell that one and buy that. 245. We are getting a nice big chunky premium for it. As a matter of fact, let me get out of this and try and go a little bit further out and try and sell this one to buy this one. Did I do that right? 60, sell that one. $1.38. So we're not even able to collect that. But you can see that, I mean, we are only a couple of dollars away, or maybe even $10 away at best on this one. The other one, we were $20 away. That is what I was talking about when we go in there and look at this under the Analyze tab, how those would be different when you guys were all like loving my drawing and my artistic abilities. So in a sense, we can see that these are very narrow. And on the IBM one, these would be much further apart, like way down here, right? Because they were $20 away. That's why we want to have the high implied volatility. Okay, so let's take a look at another one. We could take a look at Banu's throwing out Boeing. She's not afraid. I'm not afraid either. Matter of fact, I think I'm going to put this straight on tomorrow. So what are we going to do? We're going to look at it. It's a $370 stock. Move the decimal 3 ticks to the left. See if it's correct underlying. We can say it's 37 cents or 40 cents. This fits the rule, generally speaking, during open market operations. You can see it fits that rule even in most places after the market. So that works for this underlying. So we go out, try and start out with that 16 delta that we're going to look for. So start out here. I'm going to sell the 35s, buy the 30s. All right, 63 cents is not looking too good. So go out to the 16 delta, and we're going to sell this one and buy that one. I do that right? I don't think I did. I want to sell that one. I want to buy this one, and then go down to the 16, sell that one, buy that one, and $1.34 credit. So just slightly lower than what we really want. Now, you know, you can go a little bit further out here and do it this way, especially with the bigger stocks, but I like to collect a little bit more than that for my risk, and you're not going to have to go much closer, to be quite honest. So we can go closer to that 20 delta, sell that one, buy this one, and then go into the one that's closer to the 20 delta and sell that one and buy that one. So $1.60, that's right around that third the width of the strikes that we're looking for. And, you know, it being a $350 stock, we are feeling like we're miles away. It will be able to make up a lot of room, but we can go and check out the shorts. We're at 105 and, or sorry, 405 and 340, 405 and 340. So 405, you know, gets us way up into this area. You know, it's had some big moves, and then to the downside, it's going to be, what was my other strike? The 40s, the 340. I don't think the 340s are going to come in. I mean, if they've had that much bad news, I wouldn't even worry about that one so much down here. So I'm not too worried about the downside, but the upside I might be a little bit worried about here. If you believe that it's going to settle down, then obviously this would be a good time, because we got that huge volatility spike. Everybody realizes there's probably not going to be any more problems. They already sold those planes, so it's not like they can return them. And they didn't lose any orders going forward because they know that it's a software glitch and they can just fix it. So I think they're good. I'm with you, Banu. This would be a good strategy and something I'm going to be looking at doing for tomorrow. I think we have time for some more here. So what was it? Eric was asking for Intel. All right, so let's take a look at Intel here. So Intel, $50 stock. My rule, under $100 stock, we need to have 10 cents wide markets. So we go over here. You can see Intel fits that rule nicely. Problem is, implied volatility is at its lowest. And one of the things that we notice when volatility is down here at these low levels, how long does it stay there? Not very long. So volatility one would expect would start increasing, okay, because it's at its lowest lows, right? One thing about implied volatility, guys, is it's like a stock, right? It has its ranges. It has things where it wants to get stuck, overvalued, undervalued, okay? Same thing with volatility, overstated, understated, okay? So if it's understated and we expect volatility to go up, which we should if you see volatility, especially this low, that we would expect it to start going back up. That would hurt us in this instance. We want this kind of catch the volatility when it's high and starts coming out, okay? That's what we ultimately want to do. Obviously, it's a little bit easier when you have the earnings, but you will see that even over here, they didn't have the earnings afterwards and we saw the volatility come out, okay? So you can see instances where you get that volatility spiking, and even though the earnings are kind of past us, we'll see that. Oh, you saw that? Okay. Just like a contract, you are obligated to cheer for MSU Spartans in the NCAA tournament this month. Rick, I got you. I mean, Spartans, they're #1 in the Big Ten right now. They took down Michigan. I'm a Big Ten guy, so I'll be rooting for Big Tens. All right, so I would pass on Intel because I'm expecting that volatility to go up, but I would definitely like Banu's. Check your quantity. You know what? When he's saying check my quantities, when I'm doing this, what happens is this little thing, because it's on the screen, that's actually a 10 lot. See if I go negative, it's a 10 lot until I go to digits. See that? I have to stretch one of these out somewhere, so it's not letting me. There we go. So that's what it was actually. It just was cutting off the 0 on the one that had the digits. So it did maybe look like a 1, a 10, a 10, and a 10. I did notice that when I was getting ready for this webinar. I noticed it was doing that, fixed it, and it went back to normal when I started shooting this, obviously. All right. So I don't know what happened. Where did my thing go? Okay, so you guys get it. Another thing we can do, and if you are a higher risk tolerant trader, okay, like we used to do something on the floor and we used to call him a big boy iron condor. And what we would do is basically set it up the same way. So we would have to use very similar strike locations that we did before. But what we're going to do is, and we might even have to go slightly closer, is skip that strike, okay? And you're going to be able to collect a little bit more of a credit there. But then, so we're going to sell this one and then skip that strike and buy that one. So it's just a double wide. You skip a strike in between, and you need to make sure that you are very close to somewhere between 25%. It's going to be closer to 25% collection, okay? But what that does is you're going further away and you're collecting a bigger credit on it, all right? You're going to be able to collect a little bit more credit, but you're also increasing your risk a little bit more. So keep that in mind. You know, this being a $30 or a $10 wide, our probability of success is still about 70% with this. Okay. What are your winning trade and losing trade percentages? You know what, William, follow me on the daily market commentaries and follow along with me on my trades. I talk about every single trade I put on. I talk about every single trade I put off or take off. I talk about how I manage those. I can't give specifics. I can't even pull up my regular trading platform, because if I accidentally click on monitor and show you what my actual positions are, that's considered solicitation. And the SEC, the CFTC, all of those guys that are NFA, everybody is watching for that. And I can't give specifics. I can't tell you what I made last month and all of that stuff. But if you follow along in the daily market commentaries, I can't tell you, you can't keep track of it. And then you tell everybody what my percentages are. I would love that. All right. So with this one, for instance, we could take what our risk is and divide it by what our width of the spread is. This being the case, $7 is our risk. The width of the spread is $10. It's a 70% probability of success. I don't want trouble. I would love to be able to give it to you guys, but I know they'll come down on me. They have me on speed dial, I bet. All right, so that's one thing you can do also. Make it a little bit wider. You are going to collect probably closer to 25% the width of the strikes. You're going to be able to go a little bit further out sometimes also. All right, so you can do that, but no, you're collecting more of a credit, but you're also increasing your risk of loss on because of the width of the spreads. Okay. Yes, John. Good question, John Vetter. Can you explain how you manage this when needed? So what I do when I'm on this trade and I'm having to get defensive, which is what John's saying, this trade is going wrong. As soon as this underlying comes up and hits my short strike, now it being a defined risk strategy for me, John, I am going to let this thing play out for the probabilities, but I may have a higher risk tolerance. And if you are really worried about the directional move going higher and even going through, let's say, your defined risk long calls, all right, what you would do is the underlying is traded up to 405. Right now it's trading 405. If you have a low risk tolerance and you're really worried about the upside, you roll the put spread all the way to your short calls, all right? So then your short put and your short call is the same strike, and you've created an iron butterfly. That will give you another nice collection. You're going to need it to, nail that number again. You could even sometimes go to like the 400. I just want you to roll it as close as you can, collect as much premium as you can to still create either having an iron condor or an iron butterfly. Iron butterfly, the only difference is you have the same strikes for the put and the call. But you would roll it up and collect another bit of credit, okay? So you roll that down there, collect another credit. That will help mitigate some of your loss if it continues to go higher. Does that make sense? Everybody get that? Same thing for the puts. If it goes all the way down to the puts, you roll your calls down there, right? That's usually what I say to do with like the strangle or for the strangle, turning it into a straddle because it's not defined. But you can do this as well for this one. I have a tendency to let the probabilities play out when it's defined risk, okay? More likely than not, unless my assumption changes. If my assumption changes, I'm out of that strategy no matter what, right, wrong, or indifferent. If all of a sudden something comes out and it changes my mind, get out of the strategy, right? Okay, does that make sense? The POS is 30% probability of what are you trying to say there? What's POS? So in this one, what you do is you take what your risk is on an iron condor. You take your risk, which isn't this. This is my reward, right? So you take your risk, which is $7.08, and divide it by the width of the spread, which is $10 wide. Okay, so that's your probability of success with this strategy. You take your risk and divide it by your width of the spread. Okay, your probability of touch on this, oh, right. Yes, your probability of touch, John, is double the probability of the delta. So yes, and that's another reason, Banu, why if I'm selling this, it's only a 20 delta. I only have a 20% probability of this strike being in the money at expiration, right? But that being said, I have about a 40% probability in the next 35 days of the underlying coming up and trading 405, because 2 times the delta is our probability of being touched, or probability of being kissed, okay? Meaning during the life of the option, it's 2 times the delta of it just coming up and trading there. But it's only a 20% probability it'll finish there. And remember, when we're doing this with high implied volatility, especially around Boeing, and we're expecting this volatility to really come out quickly, right? Then that will get us there faster. We don't have to, all of a sudden, we're going to see those probabilities dwindle as that volatility comes out, because volatility increases the range possibility, right? So as volatility increases and that range possibility increases, that's when we want to get in on these short premium selling strategies, because it's overstated. Doesn't mean it can't go higher and become a little bit more overstated, but it means that it needs to come back. It's probably going to come back. It's more probable it's going to come in than it is going to go out when it's at an elevated level. Oh, probability of success, the credit divided by the width. Your probability of success is the risk divided by the width is your probability of success with the iron condor. Okay. All right, guys, I know we have been going back and forth on this for 2 weeks now. This is the deal we got for you guys today. It is right here with this particular link. You're going to have to pause it in. That's not the right link again. This is the right link. So we're going to have to pause and punch this into the URL. You basically get both of them for the price of one. Usually we charge $4.95 for each of these. You're getting this one and this one for $4.95, 2 for the price of one. The link is also going to be in your chat window. So the chat window, let me just make sure I have that in there. This is the best link to go with. That didn't save either. So go into the chat window and collect that, or get that one. If I go over to the slide window and pull this one up, I'm going to put this in here because this is where we need to pause and do that link. All right, so that's the correct link for this particular offer. You get the floor trader hacks, which is going to streamline your process. One of them, Banu already knew, and that's the probability of touch. All of those things will help you sleep at night. The option hacks, all right, will help you sleep at night. That is this over here. All of these different things. Those are the probability of touch, the probability of success, all of these different little things that you are going to take time trying to figure out the math in order to discern what they're trying to come up with. I give you these little hacks like double the delta. That's your probability of just being touched. What's the probability of being in the money, and all of those things all come in on the hack side. There's at least probably 7-8 hours of content there, all kinds of great option information there. And then you can sleep at night by knowing the volatility and how volatility will affect all of our different underlyings. It will also teach us how to trade in our bond portfolio. That's the part of the portfolio nobody looks at because it's boring. But keep in mind that is a lot of risk going on in there. Yes, it is government backed. You are at the end of 30 years going to get back the coupon, or the principal, or I can't think of the word. All I've got stuck in my head is the coupon. But if you try to chase coupon or chase yield by following, right now interest rates are increasing. Well, the price of those bonds are going down for those ones that you have in your portfolio because they're lower interest rates. Everybody's chasing those higher interest rates. You can't make up for that difference, okay? As the bond prices go down because you want to get an extra percent coupon payment, you're going to lose that money in the value off the value decreasing in your bond portfolio, all right? It's going to take you like 10 years to make up that coupon payment on the money you lost there. I show you to go step by step how to trade in and around that, all right? And when it's appropriate. So make sure you guys take advantage of this. Like I mentioned, this link up here did not save on my computer earlier. You have to go with the link here that is written, or the one that is in the chat window. That's the easiest one. That has the direct link. Or pause the video right here. That is the link at the top. All right. I just want to thank you guys all. That's it. I'm wrapping it up. If you want to sleep at night, do the crush. If you want to streamline your process and save yourself about 30 minutes a day, go with the hacks. All right. Also, it's going to make your life a lot easier. Click on that link right there in the window. We'll get you set up. Or if you're watching on tape delay, you'll just have to pause right now. All right. Thanks, guys. That's all I got for you guys. Other than if you can't take that, take it easy. I see a couple of questions coming up real quick. I'll get to those here now that we're done with that. Yeah, the link's in the window. I sent it out to the entire audience. Yeah. We've been going back and forth in the questions. There's a separate section over there that says chat. All right. Eric got here late, missed most of the session. Any chance to get the replay might come in? John, we are sending this out. It takes me a little bit of time to compress the video and send it out, all that stuff, but you should be getting it at least by this weekend. John also says, Boeing just announced stoppage of delivery of the 737 MAX series and worldwide groundings. That will the price drop more? I think that they already announced those, and they said it's going to be about 3 months to get all the software updates to these planes. I'm sure they're going to the ones that are already purchased. The ones that are online probably, or at the factory still, are going to be the last ones to get fixed. But I think the worst is out there, and they're going to be all right. For you, Only Wolf, the best way to sleep at night. Yes, Rick, I'll agree with you, Hamrick. All right, got here late, missed out the most. Yeah, replay will be coming. Good enough, guys. Take advantage of that link. Like I said, it's in the chat window, or if you're watching on tape delay, you're going to have to pause the video here and watch that. All right? You guys take care. John, we're working on it. Like, compliance with live stuff is tough, but we are working on it. We're going to probably be trying to do some more live stuff coming up in the next month or two, but we got to get it all through compliance. Just like I have to trade from my fake platform, all of that stuff. I got to really be careful what I say on those things. All right, guys, take care.